Yes, people. How are we doing? Great to see you all. Thank you very much for joining me today. Make sure you get them likes in. Let's get the likes. Come on, let's go. We are 6 minutes away from the Fed interest rate decision. I believe my trade should still be open from before, I think, in today's previous live stream. Yeah, we're back down. I should have closed it up here, shouldn't I, going into this? We'll see what happens anyway. But yeah, come on, let's get the likes in. Let's get going. We've got really good viewership. We've got 46 people, 5 likes. So come on, we are really slacking on the likes. Let's get the likes in for me streaming this FOMC rate decision announcement. Let's get it going, people. Come on. Get your likes in. Of course, if you are looking for anywhere to trade today, make sure you click the links in the description. Sign up to BLOFIN. Sign up to BitUnix. The links are in the description. Let's get them going. And yeah, let's show some support to the stream. So go and drop this stream link into a random Telegram group, random Discord group, whatever it may be. But yeah, let's get the likes going, people. Come on, with 6 likes, scroll down, drop a like. Make sure you subscribe as well. Anyone who's new, make sure you get your sub in. And let's get going. So we do have the rate decision coming in. Let me try and refresh this. I think I've just zoomed in by accident. Yeah, I have. Right, let me try and fix this, because we need to fix this before it comes out. Can I get it done? Hang on, just let me swap over. But yeah, welcome everyone. Make sure you get your comments in as well. Let me know who we've got in the comment box. Obviously, I assume we've got a lot of regulars. But anyone who's new, let me know. And let me know where you came from as well. Did you see this link on YouTube? Did you see it on X? Where did you see it? Let's get it going. Yeah, we have got 4 minutes to go, so get excited. Get excited, people. Let's go down to the 1 minute chart for it. And we will, of course, watch Bitcoin. Well, yeah, let's see what we're going to get. What do you think we're going to get? Evening, Stonksy, Jeff, Crypto Bro, Nick, how are we all doing? Legends. Absolute legends. Great to see you all. Come on, let's get the likes in, people. Scroll down. Make sure you're subbed as well. If you're watching over on X, make sure you head over to the Stonksy YouTube account. You can find it in the bio. Or, of course, you can just type in Stonksy Indicator on YouTube. Up over there, drop a subscribe. Every little one drags us close to 2,500 subs. And yeah, what do you all think we're going to get? Let me know in the comments. What do you think is going to happen? Obviously, it's the resounding expectation that the Fed will hold rates. Sorry, that is the live stream. But it was, yeah, a 98% expectation that there is going to be a hold of rates. So let's see. Bell. There's going to be no bell. Likes are weak for sure. I know, mate. I know. Hold. Yeah. I mean, the market would be shocked. It would be a huge shock to the market if they didn't hold. If they cut, the market is not expecting that. So, yeah, we've got 2 minutes to go anyway. Make sure you get your likes in. Come on, subscribe. And, of course, click them links in the description. Sign up to BLOFIN. Sign up to Bitcoin. We recently announced our partnership with Bitcoin today. We've been long-time partners of BLOFIN, but we announced our partnership with Bitcoin today. So using the link in the description, or it's pinned in the chat, or you can find it obviously on the Twitter here. You sign up with it and you get yourself some great deposit bonus. So you can find all the list here. You can pause the stream if you want, or you can come and find it obviously on X. But you know, you get new user welcome bonuses, futures volume challenge, and a 24-week check-in challenge. Also, you get deposit bonus as well. So you deposit $500, you get $100 futures bonus, obviously, and then 1,000, 2,000 is increased. So do go and grab yourself that. Sign up to Bitcoin, and of course, yeah, grab your welcome bonuses while you can, because we've got a great selection on for new users while we've just partnered with them. But we are still partnered with BLOFIN, so both of them links are in the description. Grab them while you can. And we've got just under a minute to go, so do get excited. Let's go. No, there won't be. I very much doubt there'll be rate cuts. The market isn't expecting that. What do you think? Market will pump or dump? I think we'll just get a whipsaw, to be honest. I think we'll get a whipsaw. And then if Powell indicates, obviously, in his conference at 1:30, so we will be staying on after this. Don't go anywhere. We will be staying on to watch Powell's press conference. If he indicates anything that hints that they'll cut in September, then obviously I think the market will take direction from then. But it seems likely to be September. Now, will he even be here in September? Who knows? Anyway, 3, 2, 1, and boom, there we go. So what is the market going to do from that news? Not had much going on so far. Are we going to get a spike at all? Judging by the reaction, let's give it a little refresh. I assume that they held rates. We are pumping it a little bit. Yeah, that 1 minute candle starting to go now. Yeah, unchanged. There we go. So it was the expectation. Our trade is back into a little bit of profit. Would have been a much better profit up here, wasn't it? But we'll let it run anyway. And there we go. There's the 1 minute candle going. So yeah, Fed has left interest rates unchanged. No change. So the next one will be mid-September. So we've got about 6 weeks, haven't we? About 7 weeks until the next Fed meeting. Now, do make sure you stick around because we will be watching the press conference live where Powell will give his speech, and then obviously he'll do a Q&A with the press. We will have that ready at past, so 29 minutes to go on that. So yeah, don't go anywhere. Go and get yourself a cup of tea, get yourself some snacks, whatever it is. If you want to stay and join me, I would be very much appreciated if you did. Kept me company. I'm going to short that pump, says Jeff. Well, if you did, mate, I assume you're already in profit. September cut. It's already 50% chance. It seems that way, doesn't it? It seems that way. So if that is going to be the case, if it's already on the cards, then we should get some indication from Powell in the press conference today. In theory, we should get some indication, which then should let the market take direction into it. Now, it could turn out to be, if that's the case, and the market starts rallying into September, it could be a massive seller news event because the pump, in theory, will happen before the actual event. But that's a nasty 1 minute reversal there on Bitcoin. So we did have a little pump up, but now we have, had a deep flush down. Deep flush down. So are we going to continue heading downwards? He's Judas. Evening, Loki. How we doing, mate? Great to see you. He's Judas. Bitcoin is heading to the downside following that unchanged decision by the Fed, which is no surprise. It was a 98% probability that they were going to leave rates unchanged. So, I don't think there's anything to be surprised about. But please do get your comments in. What do you think is going to happen next? Huge dump. Really nasty for obviously any scalpers. We are only on the 1 minute time frame. I mean, if you zoom out, we're literally just back to the same levels as we was 4 hours ago. But obviously, for the scalpers out there that may have been trying to, that was a really nice low time frame range that it formed leading into it, wasn't it? But yeah, there are three nasty 1 minute candles there. Yeah, 3 nasty 1 minute candles. But yeah, big up everyone that's joined. Thank you very much. Like I said, please do drop a like, and of course, please do sign up to BitUnix if you haven't already. Obviously, most of you will have a BLOFIN account, I assume. Please do come and also join with BitUnix. That is second link in the description. It's pinned in the chat. Just throw it in the chat as well. Do sign up to it. You get yourself some great welcome bonuses. If you do want to know the welcome bonuses, you can find it. I'm actually going to pin it, so you can just come on and see. Let me pin. You can just come on and see. But yeah, it's non-KYC, but there is obviously a full tutorial on the Stonksy YouTube now. So do come and check that out. Full tutorial as well on setting it up. But yeah, some really great welcome bonuses, and obviously bonuses for completing challenges as well, as you would typically expect. But these are obviously put on for Stonksy, so yeah, you won't get these with just signing typically up to BitUnix. These are put on for us to offer to you guys. So yeah, do please check that out. But we're getting a bit of a reversal on Bitcoin now. We're getting a bit of a reversal on Bitcoin. Yeah, let me know what you guys, is anyone trading this? Has anyone put any longs or shorts on since the decision came out? We are still long on the streaming accounts. But yeah, let me just get a quick drink and then we will carry on. Right. Funny how we all knew this was going to happen and everyone freaking out. Now send it. Nothing new, but still holding my shot. Yeah, I mean, that's it. I mean, I'm still just going to hold this because there's literally no point in closing this out. There's literally no point in closing it out. We may as well let it hit the stop loss or ride it up here. If I was going to close it out, I should have done it before. But yeah, we'll let this play out. We do just have just over 20 minutes until Powell starts his conference. Has the Fed said something? They've left interest rates unchanged, so they had the meeting today and just announced it 7 minutes ago that they are leaving interest rates unchanged. So that's been the news, RN. Yeah, they've left interest rates unchanged. But that was the resounding expectation. It's not like it's a surprise or anything. It was a 98% probability of them leaving them unchanged moving into this meeting. So it was the resounding expectation. It's not really caught anyone by surprise. But obviously now, a lot of people are expecting. I can pull it up actually. Give me a second. Let me pull it up. A lot of people now are obviously expecting September to, maybe bring the cut. Now, if that is the case, I think it was last meeting Powell said, a few members were starting to ask for cuts or, suggest that they wanted a cut. We've got obviously a gap now between now and the 17th of September, which is off the top of my head, I'm guessing like 6 or 7 weeks. Now, as it stands, it is 61% probability that they're going to cut 25 basis points. Now, this can obviously massively change between now and then, depending on what he says, in this conference, the economic data coming between now and then. There will also be Jackson Hole. So Jackson Hole is a huge yearly economic event in the US, and that normally happens at the end of August, I believe. So there will be that as well, which will be, a really big thing for Powell to speak at to. So that will be just a few weeks before the next meeting. There's plenty to happen between now and then that can change this, but the expectation, I believe now, is that the Fed will cut in September, which could give us a huge buy the rumor, sell the news rally. Obviously, if this takes flight now, moving into September, we could have 6-7 weeks of really, anticipation and expectation of the cut, which I think would be a buy the rumor, sell the news event, and could be quite significant for the next market move. He had to show some balls. I have no doubt that Powell shows his balls every meeting. Just plonks them on the desk and says, yes, some things my balls are small, they are not. That is, of course, a joke. I don't think Powell probably gets his balls out at the meeting, but you never know. You just never know. But yeah, we have 20 minutes to go until Powell starts to speak. Bitcoin is now fully reversed. So we did get this small pump up. Then we got a pretty harsh drop down. And now we've fully reversed that drop, which is nice. would say that's nice. Has the Bitcoin tattooed? Imagine. Oh, mate, imagine how much that'd hurt. Christ. Imagine how much that would hurt. How many total views did we get so far? Wow. It's a lot of views, that. Most people, on these ones, most people just jump in for the rate reaction and then just go. So big up anyone who's still here. But yeah, get your questions or thoughts and feelings in through the chat. What's ETH done? So ETH, yeah, holding nice and strong, 3,800. Very nice. XRP. Yeah, alts have recovered a bit, haven't they, today? They've recovered throughout the day. He was getting absolutely slapped, some of them before, you know, down 3, 4, 5, 6, not even 7%. But they have recovered, obviously, with Bitcoin's push back up, which is obviously good to see. We still here, and I really like them by the rumours for the news theory. It makes sense. Yeah, I think so. I think so. I think it was JP Morgan. The bank are beginning to accept Bitcoin as collateral. I think they're starting to really use stable coins too, aren't they? I think they're really starting to accept stable coins. What should we look at next? What should we look at next? We've got 15 minutes to go. Let's have a look at some liquidation levels, shall we? We've got obvious liquidity downside. I mean, but that liquidity upwards now has been building, you know, definitely over the past week, 10 days or so. This liquidity above 120, I find it hard to believe that the market doesn't go and grab that. I think like the ultimate kind of, if the market is going to go down, say in this scenario it's going to go down, I just think like a big FU move of just that would just be so much more like brutal than just simply just sending it down from here. Coming up and obviously clearing the liquidity above here, running these stops, and then just obviously just cascade it down, I think is a lot more brutal. And, you know, obviously this would flush out the top side liquidity than just sending it down from here. But, I mean, yeah. Who knows? Who knows? Listen to that foot massager. Can you hear it, Jeff? Can you hear it? Now, how many times do we think Powell is going to say well anchored in this conference? How many times do we think he's going to say well anchored? I know that you can hear little splish and little. I can hear little splishes and splashes. Where's that coming from? Where's little splishes and splashes coming from? Well, we've only got 10 minutes to go. Does everyone think my position is going to survive? Or do we think it's going to get absolutely ran through? What do we think? I think I don't know. We're kind of dancing with the devil a bit at the moment, aren't we? I mean, we're still alive. I don't know whether it will get to my take profit or not, but that's part of the idea of what I shared, is coming clearing upside liquidity. So we'll see. What is it? Missed it from earlier. What's what? Jeff? You must have dainty feet in your foot massager. Size 9? I think I am. I'm only a size. Yeah, not. I wouldn't say they're massive feet, but I wouldn't say they're dainty. Size 9, maybe size 9.5. It's just a small long, Jeff. It's just a small long. We opened it on stream, and we survived the drop down here, but then it did actually pump up here, and I just thought I'll leave it, and then obviously come all the way back down, and we have survived obviously the rate decision news. So we'll see if we survive after that or not. I think really it just lines up with my theory of just like up, swipe liquidity, trap people, and just cascade it down. I'm size 12, and you know what they say about people with big feet, big socks. Exactly. And big shoes too. And big shoes. Can't forget about them. Big shoes, my boy. Big shoes. Come and sign up to Bit. Has anyone signed up to BitUnix? Let me know. You regulars that are in the chat, that's still here. Has anyone signed up to BitUnix yet? Has anyone gone and took the plunge and signed up on the Stonksy link? Any of you legends done it? What Bitcoin stocks do. We'll have a look now. We will have a look now, my good sir. No, I don't like the idea of giving my ID. Yeah, that's fair enough. So we had MSTR is up 2% on the day. Coinbase is up 3%. We've not really done much with the Fed reaction. Like Circle is up 4%. Obviously not directly Bitcoin stuff, but crypto stuff. And we do have obviously some more to go through. If you want me to cover, say, Tron's coming back down now. Obviously, Tron had a really big pump up, didn't it? With its what was it? What did we call it now? A remerge or I can't remember. SBET. That's the Ethereum one, isn't it? But yeah, these are all Bitcoin related stocks as well. All these. Some of them very, very small. Some of them bigger than others. But yeah, not really much movement, obviously. Yeah, MSTR coin, Circle up. Miners, actually, we skipped over the miners, didn't we? I've not got many. I need to add more miners on in here. I want to get all the miners on there, but again, miners just kind of mixed bag. Some of them up 3%, but yeah, not really much movement across the whole market. No worries, mate. Thanks, Jeff. Thanks for joining. Nvidia now sits as the second highest asset class by market cap in the world at 3.2 trillion. Yeah. Well, it's the most valuable company, isn't it? It's the most valuable company. Well, I suppose in terms of asset, yeah, it's just second behind gold now. That's crazy considering I'm pretty sure I remember it well when it got 1 trillion. What's the second most valuable company? Not asset, but company. What's second to Nvidia now? And how much is it worth? I mean, we could go and have a look ourselves, but it seems like you've already got it open, maybe. If not, I can go and open it over. Well, what is the next valuable company, and what is that worth? If Nvidia is now 3.2 trillion. Coming back down on Bitcoin a bit now, aren't we? Ooh, that's a nasty 1 minute candle. Oh, look at that. Ooh. Wonder, looking to see if anything had happened. Nasty candle. Microsoft is spotted value. Yeah, Microsoft has been in like really good price discovery, hasn't it? It's got like all-time highs in price discovery. 2.8 trillion. These figures are in pounds. Wow. So like Nvidia would be like, what would Nvidia be then? In dollars. It'd be quite a lot, wouldn't it? Right. Are we all ready? Are we all ready for Powell's conference? 3 minutes to go. Is everyone excited? Is everybody excited? Yeah, I mean, it's unbelievable just how much the price is hanging around this entry, man, isn't it? I'm sure you must be looking at exactly my entry. I think that's what it must be. Anyway, what I'll do is, shall I? I'll put. Let me do this. Hang on. Let me stop this. And what I'll do is I'll split the screen. So we'll have Powell speaking on one side, and then we will have Bitcoin chart on the other. Let me just sort everything out. Let me get that halfway. Yeah, right. Let's pull this over. Right. Let me guys show you. Let me know if this is all right for everyone. Is this all right for everyone? Can you see everything? Let me know if you can see it all. You should be able to see the Bitcoin chart, and then obviously this side for the conference whenever it comes on. Can everyone just confirm that they can see that? Listen to the funky music that they play. Everyone confirm that you can see that. Can someone confirm it at least? One person confirm it. Yes, mate. All right. Okay. All good then. Right. Here we go. Hang on. Let me get rid of that. What's it doing?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information. And, I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Bitcoin's dropping hard, isn't it?
Hi, Mr. Chairman.
Coming from my stock.
Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace. And that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we, of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't... You're right. That's what it says, and that may well. I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one, so I'll just say that we haven't made any decisions about September, monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market? So
let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate, and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is
it's gonna stop me out.
Revenue being collected on the order of $30 billion a month, which is, substantially higher than before. And
look at it,
the
so
evidence
close.
seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals. And that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation, sometimes early in the year, and then inflation turns lower. And a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait and see approach is
The
giving.
wait and see approach. What do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait and see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay, this delay though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover though to raise prices?
Well, what may be giving, it's not our policy stance. What may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just go across the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's a kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. And we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down? I think closer to 2.
We'll look at everything. as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't.
And there we go. I think we'll leave it there because obviously the longer that it goes on, the more irrelevant, well, not irrelevant, but the more less exciting the questions get. So basically, if we was to round up exactly what he said there, still no hints at an actual September cut. Powell just being Powell himself, saying, we'll wait for the data. They have 2 lots of CPI, they have 2 lots of employment data before that September meeting, and wait and see. Now, obviously, the market is pricing in, as it stands, a highest probability of a 25 basis point cut. So we'll have to see. But, Powell being Powell, very conservative the way he answers, not really giving anything away, and really just gives the answers you'd expect of saying, we just got to wait and see. But big thank you to everyone that joined me for this. Obviously, my second stream of the day. Thank you for joining me for covering that. And obviously, Bitcoin has taken a tumble. We are currently at 16,366. So congrats to anyone who took a short. We have sold down all the way throughout that conference. So thank you very much for joining me. Obviously, I'll be back tomorrow, my usual time for streaming in the daytime. And until then, take it easy. Have a nice evening. And if you're watching the rest of the conference, enjoy. But I think it's over soon, and I think it normally goes on for about 40 minutes or so. Make sure you drop a like if you haven't. Catch you tomorrow. Bye bye.